Okay, back after a few weeks absence. I was working on a few projects and things, and it will be absent again next week as I'm away on business travel, seeing clients, but here it is, top 5 charts of the week, video run through on YouTube. First one here is Fed QT quantitative tightening versus the US dollar index. So just to clarify here, on the right hand side we've got the year-over-year change in the Fed's holding of treasuries, and that's shown against the US dollar. Now, there's a lot of different factors that go into determining where exchange rates should be trading or where they will trade, where they have traded. But this one, it at least outlines a scenario where the US dollar can actually go stronger from here. So we've had this really interesting rebound from completely oversold levels, where there's also bullish divergence, bullish brief divergence, and the stretch futures position to the downside against the backdrop of still very compelling yield support for the US dollar. So we've had phase 1 of that, and this chart's basically arguing that phase 2 is that it goes higher from here. So it's one to ponder, because if we do get that other leg up, then that's going to cause ripple effects across commodities, emerging markets, and the whole global market, global macro environment. So definitely one to have on the radar. Second one is also one to have on your radar. This one shows cyclicals versus defensives. And that's basically the stocks that, or the ratio of the stocks that are more sensitive to the cycle versus those that are generally more defensive through the market cycle. And you can see there, this is across the main regions. The one that really sticks out to me is Japan. I'm going to be doing a bit more work on Japan, especially for the latest weekly report. But you can see there that it actually rolled over just before the turn of the year. So it actually rolled over before the correction got underway. So it's a really interesting sort of, I'm going to be looking into whether that's a barometer for, a leading indicator of what's, coming there. But you can see there that there's a bit of difference across the regions. For the most part, UK, Europe, emerging markets are actually looking fairly similar, but it's America that stands out there. And that's the one where I'd say it's probably the most stretched. And that's something we've been talking about for a while. Cyclicals very stretched against defensive. So I think that's a risk area in the market. And the fact that we are seeing cracks appearing here, I still tend to lean optimistic, because that's what tends to work long term. But then you look at things like this, and certainly makes you more conscious of risk management. Number 3, the Reflation positioning indicator, which I've called a bit of a Frankensteinish compilation here. This one shows the combination of crude oil, copper, equities, and treasuries and dollar index inverted futures positioning. And you can see that it's rolled over from very extreme levels, and that's usually something that you want to pay close attention to. So I guess it's kind of lines up with the previous chart, actually, a little bit of wavering of conviction in the whole growth reflation kind of environment that has prevailed for the last year or two. Number 4, again, we're talking talking a lot about the risk situation at the moment, and this one shows the quite profound breakdown in emerging market currencies, as you can see there. The red line is 200-day moving average Brent across 25 countries, so 25 different emerging market exchange rates. You can see that that absolutely collapsed to 0, and that's quite unusual. Short term it's probably oversold, but then you look at that 14-15 period, emerging market currencies broke down, Brent broke down, it was oversold and stayed oversold throughout that period. So it's one to be mindful of. The one probably that is most interesting with these two charts is how commodities travel a similar but different path to emerging market currencies. But you can see there that there has been some breakdown in breadth there, but not nothing like what's happened with emerging market currencies. So, you know, the pessimist out there is going to be looking at these two and saying that commodities are the next shoe to drop, which from a global risk perspective is pretty key. And final one is global REITs. So this set of charts, and actually the previous set of charts as well, they came from the Global Cross Asset Market Monitor, which is a new weekly markets monitor report. That's just been added on to clients' subscriptions. I can offer that by itself, so if you're interested in that, get in touch. But what these are showing here is that if you look across global REIT markets, they've all recovered quite nicely since the correction. I mean, these ones were at the forefront of the initial stage of the correction, which, if you recall, was driven by that drive up in yields. And, and then being still equity market sensitive, then, they sort of got dragged down as well, participated in the broader risk off. But since then they've recovered, and probably recovered a little bit better than broader equities, just say, global equities, for instance. And that's because bond yields have been stuck in a range as well. And so that's something, when it comes to REITs, bonds, duration risk is pretty key. If you look across, back across some of these sort of warning signs there, maybe that's a case that bond yields stay low or even go lower. So that would be a tailwind for the REITs. But, if this is just a little growth scare, a little bit of a wobble on the way back up, and, we have another push higher in bond yields, then, the fact that these guys are all, whether it's Europe or UK rather on the left there, or US, Australia, Japan, they're all trading at the top end of the range. So, that kind of makes it a little bit more vulnerable than usual if you do get another push higher in bond yields. So look, I will leave it there, and if you've got any questions or comments, put them in the comment section below. If you like this video, then go ahead and subscribe to the channel so that you don't miss out on any future updates.